Chart patterns is a visual representation of a psychological scenario, trading scenario in a certain period of time. So knowing it will give us a tremendous advantage in the stock market. Today, in part 2 of the crash course of chart patterns, we're gonna go over the rest of the chart patterns. And guys, stay tuned what's gonna be said after going through the chart patterns and learn which one of those patterns apply for swing trading and day trading and which one are the best. In part 1, I kept saying, this is the best, this I'll tell you later, I'll tell you later, I'll tell you later which one. Now you're gonna see it in this video, which ones are the best and why. So let's dive in, shall we? Hey everyone, Zach here and welcome to the world of investing. This channel is specifically for new traders and struggling traders to improve and get better at trading and investing. Let's get to the charts. So the first one we're gonna go over is the channel pattern. The channel, it's just a horizontal channel pattern. That's an example here on Ford. So it comes with a horizontal support. It was resistance, became support, support, support. And it comes with a horizontal resistance. So we have resistance, 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 resistance. Just to show you here, that's a support area. And that is a resistance area. All right, what's the psychology behind it? So the psychology behind it, the bears and the bulls are not winning on the same level in the battle. So as you can see, we have resistance right here, resistance right here in the same area, resistance right here. That's from the bears. They're not pushing it down. They're not pushing. They're not letting it go up against them. So they share the same strength in that, and the bulls having support right here, support right here, and support right here. Okay, once it breaks, the other party will actually try to make a rally out of it. One of them will get exhausted eventually. In this case, the bears dominated, but they weren't able to actually rally it all the way down. I have another example. So let's see, like here, okay? That is a straight support and that is a straight resistance. That's a channel, horizontal channel. So we have resistance here and resistance here and resistance here, resistance here, resistance here. And we have support at the same level, support at the same level, support at the same level. But in this case, the bears actually took a nice stand where the bulls tried to pull it back up. You see that support, it became resistance, and then look at this big, huge rally. If I was trading, I didn't trade that, but if I was trading this, I would have got in right here. After the test of that previous support, it became resistance, I would ride it all the way down. And the second one is the upward channel. So they're parallel, but it goes upwards. And there's a lot of examples on that one. Let's find one. So here's an example of an upward channel. You go like this. You see this channel? Let me just fix it. So that's a parallel channel, but it's upwards. That's all. So the support, it's an ascending support or going up, and the resistance is going up. Just to show you, support right here, support right here, support right here, support right here. Resistance, up here, resistance up here, resistance up here, resistance up here. Okay, what this means, the psychology behind it, the bulls are dominating here, okay, and they're holding higher support levels. So that's a support level, and that's a higher support level, and that's a higher support level, and that's a higher support level, where they're able to break higher resistance level. That's a higher resistance level, so the bulls are able to break it. And it's going up, it's going up, and it's going up. Now, but what do I wait from this kind of channel? I wait for it to break to the downside, where the bulls will get exhausted and they get disappointed. I like those channels, and I sometimes trade them. They're clear, and it's clean channel. There's probably another example. Let me see. And here's another example. Upper support, and in the same parallel, upper resistance. So here's a support. The bulls were able to make a higher support, and they were able to make higher support and a higher support, and they were able to break the resistance walls higher and higher and higher until they actually broke it. All right, now on the break, see, on this one it broke and it tested. Now it's going up. Now the thing is, I wouldn't trade this just for one reason, because the volume here, it did not break it on high volume, so it has a high probability to be a fake out. So it fakes people, they get long here, and then it fakes them all the way down. They end up losing. As I'm gonna say at the end of this video, but I'm gonna mention it now again, knowing the patterns is not enough for you to enter a trade. And now we have the descending channel, or the downward channel. That's a good example of a downward channel. It's going down. Fix it. And the resistance is going down as well. All right. So in this case, it's the other way around. The bears are able to make lower resistance, lower highs, and they're able to break the support areas that we have all the way. So they're breaking them lower and lower and lower, lower highs and lower lows. In that case, the psychology behind it, the bears are dominating here, where they're able to break the support areas of the bulls. Okay, but what do I wait from this? I wait until it actually breaks to the upside. So when it breaks to the upside of this channel on a high volume, if there's a high volume, that can be a signal for a reversal, and it might go all the way up. And that's how I enter those trades. I don't enter those trades when it breaks it to the downside. Usually I don't. There's another example, maybe. Let me see. Downward channel. There we go. That's another one. Okay, I want you guys to try to... it's easy to point it out. Look at this channel. There we go. Okay. So in that case, what happens here? I'm pretty sure you guys understood it, but so the bears took a stand and the bulls took another stand. The bears were able to actually not let the bulls take it all the way up or break it, so it's a lower high, and they broke their support area and they made a lower low. Back again, lower high, lower low, lower high, lower low, lower low, lower low, lower high. You see how the bulls, the psychology behind it, the bulls are dominating here. Now, as I said, I wait until it makes a reversal. If it was to me, I would actually enter the trade right here, okay? But I wouldn't do this in this case just because it did not break out on a higher volume here. It did not. I didn't see any volume. I would not enter this trade. Doesn't mean it's not gonna go, but the probability is not as high as it's supposed to be. The other pattern is it's called the double top. Let's see if we find here for a double top. Here we go. That made here a double top. It's not the cleanest, but it still works. So double top means it looks like the double top looks like an M shape. So it goes up, down on a higher low, and then it hits the same resistance area, and then it goes all the way back down. Okay, now this is formed of two tops. Let me just put that, okay, and a neck. The psychology behind it, that's where the formation happens. Now, a lot of people try to actually anticipate this move by the top here, and they anticipate it's to make a double top. I don't. I usually wait for the break of the neck, okay, and then the bears dominate after it breaks the neck, and the reason is the bulls get disappointed, all right, and then they dominate the move all the way down. I've traded those many times. Let's see if we find another example. Okay, here's another example of a double top. Let me draw it down. So that's a double top pattern. The bulls make a stand right here. They push it all the way up. The bears make a stand right here. The bulls make a higher low, okay, and the bulls make a higher low and they push the price up. The bears take a stand at the same area. It pulls down. The bulls actually hope that they either make a higher low or take a stand at the same area. They don't, and once it breaks that neck level here, that's when the pattern formed completely, and that's where I get in. That's where I would get in a trade like this. Also, I look for a high volume breakout. Now, this is a higher volume breakout from the previous. As you can see, those two candles are higher than the ones in the previous ones. I might have got in right here. I usually like the retest back to the support area, and then get back in. It's not as clear. I wouldn't probably trade this, but that's an example of a double top bearish pattern. Okay, now we have the double bottom bullish pattern. It's the same psychology, but it's the other way around. Double bottom, it makes the shape of a W. Actually, on this chart I saw something here. Let's see. There you go. So now we have, that's a double bottom. It makes a W shape pattern. Okay, it's the same concept as the double top, but it's reversed. Okay, with bulls and bears. Let's do this. The bears take a stand at an area. It goes all the way down. The bulls take a stand at a support. They make a support, and they push the price high. The bears take a better stand where they make a higher low. They feel that they're gaining confidence and hoping that they will break this support area, but they couldn't. Okay, now when they couldn't, they still give it a try, that they either hold the same area or make a lower low, but the bulls actually dominate and they break that resistance area, and that's when the pattern is broken. Okay, and look at this candle. Actually, this candle, it belongs to this one. So it does not break the support area. Let me just, the neck. The neck goes right here. It does not break the neck on a very high volume. See, the volume is lower. I wouldn't actually enter that trade. That's when lots of fake outs happens. And that's when you actually get caught in the wrong side of the trade. And there's probably another example of double bottom. Here's a nice example of a double bottom. The bears makes a resistance, pulls the price down steeply. The bulls actually make a support. The bears makes a lower high, so they take a better stand. The bulls actually take the same stand. Now the bears hoping that it's gonna make a lower high, or they're gonna hold their resistance area here, but they do not. And that's when the pattern is broken and it goes all the way up and it makes a rally. You can capitalize on this kind of move. And that concludes all our patterns from the first video and the second video. After going through all those chart patterns, I know it's overwhelming, but you guys can go over it again and again until you understand them, until you memorize them, or you note them down or list them down. But here's what I want you to take out of it. Number one, whether it's a bullish pattern or a bearish pattern, it's not written in stone, guys. I just explained the psychology behind them, but what's more important is after each pattern, you should expect a high probability of a big move. And when that big move happens, that's when you can react. Number two, after the pattern is formed and it's getting to break out of this pattern or ready to make the move, watch the volume. The volume is very important to tell you whether this move is gonna be a big move or just a fake out. The higher the volume, the stronger the move it can be. Number three, by knowing all these patterns does not mean that you can start jumping into trades. There's a lot of factors that play a role, and I'm going through them one by one, video by video, and probably at the end of this series, I'll put together a trade from A to Z. So folks, my friend, please don't jump into trades knowing that the patterns and the psychology behind them yet. It plays a big role in your trading, but not yet. And here comes the question. Which of those patterns apply to swing trading? And the answer is all of them. And my favorite patterns for swing trading is head and shoulders, inverse head and shoulders, ascending wedge, descending wedge. And why is that? As you can tell, I've mentioned two major emotional state in the previous video and this one, whether the traders are getting exhausted or they got disappointed. And in those patterns that I just mentioned, they actually, both of them will apply. So I love the patterns where the traders got exhausted and on top of that, they got disappointed. It gives me a better probability and it works with me. But when it comes to day trading, I almost don't use any of them. So those patterns mainly, and you know what? People that are learning from YouTube, they learn these patterns and they go applying on day trading. No, it does not work in day trading, all of them. Maybe the bull flag, the bear flag, okay, sometimes I would use them. Cup and handle, sometimes I would use it. But in day trading, there's so many other factors that play a role. The first one is there's not enough candles or time enough to form a full head and shoulders, for example. That's a big, it needs a lot of time or a lot of candles to form it, okay? They do not apply. A channel, it does not apply as much, okay? Maybe wedges, sometimes it does, the ascending or descending wedges, But there's a lot of other factors. Indicators play a role. The time of the day. So when you're day trading and let's say it's a bullish sentiment and you think it's gonna go up, but the pattern actually finished forming exactly by lunchtime, I would not go long on lunchtime. Or by the end of the trading session. There's different things that we need to factor in, and I will go through them later in later videos. But in day trading, most of them I might use the flags, bull flag, bear flag, ascending wedge, descending wedge, okay? Maybe some triangles, ascending triangle or descending triangle in a smaller form or shape. But after this video, when I go through indicators, then I'm gonna make a video about more patterns that I use in day trading and how do they align with my indicators. But also make in consideration, I also day trade based on the formation of those patterns on a daily chart. So when something forms and it gives me a bullish sentiment on a daily chart, which is for swing trading, that day I might be bullish bias, okay, or go long on the day of the breakout of the swing trading formation. So I utilize these patterns to my benefit in day trading, but I don't actually use the actual form or the actual pattern inside intraday. I can't cover day trading patterns unless I have the indicators covered. So stay tuned for the next episode. Click here for indicators. If it's not there, it'll be there up soon. And if you have not watched the first part of chart patterns, click on this video here. I hope this video was informative. Make sure you hit the like, subscribe button, and I'll see you next time.